Hi, I'm Penny. This is our third video on our topics for week 1. Got a few different things to talk about in this video. First of all, we're going to talk about what are the different ways that we differentiate the investments. So how do we describe the investments? We can talk about them in a number of different ways. So for example, we could talk about them being intangible or tangible. So tangible is something that you can hold. You can see it, there it is. So for example, property, artwork, gold, those kind of things we can feel, touch them, so that we could describe them as being tangible. Intangible assets, well, that's where we would talk about our Bitcoin shares. When you own shares, you don't have something to hold on to, or bonds. So we can talk about our investments are intangible or tangible. Another way we can describe them is being direct or indirect. So direct is when you yourself buy the shares on the stock exchange and you're the shareholder. So you are a direct owner of the investment. Or indirect. So if you've invested in a managed fund, they buy the shares, they actually own them, and you are buying what are called units. So you don't actually own the shares yourself. So direct and indirect. We could use the words debt and equity. So debt, we buy bonds, then the government, if we buy a government bond, they owe us money. We've lent them money and they have to pay us back, and they will, which is the good thing. Equity, those are shares, so when we're owning part of the company. Or we could have derivative securities. So these are options and futures, and that means they derive their value from the underlying security or asset. We could talk about the risk levels being low or high. Perhaps we would use the maturity. So short to long term, how long before the bond finishes? Is it a short term or is it a long term bond? And what's the location? Domestic or foreign? Did we buy Australian shares, domestic shares, or did we buy international shares? So these are some of the words that we can use to describe our investments. So risk and return, these are important concepts for our investments. So do you think there is a relationship between risk and return? If you are buying an investment that is riskier, do you expect your return to be higher or lower? What do you think? For most people, if we're going to have a higher risk, then we expect a higher return. So we can see risk across the bottom axis, and then the vertical axis has return. So we have the risk increasing, and you can see the return going up. We've got this formula here. So we're expecting the return to equal the risk-free premium and the risk premium. So this bit here is the risk-free return. And then as it gets higher, we've got the risk premium adding, and the risk premium, the red bit, is increasing. We want more and more return for the higher risk. This is also a risk and return graph, and it's got our different types of assets on the graph. So we can see cash in the mattress, well, that's even below the bottom. There is no return for that. Cash in the bank, well, that will give us a tiny little bit of interest, so that's on the bottom for the return. Very low risk. Cash in the bank. Then we're moving up to short-term treasuries and domestic government bonds. They are extremely low risk, but their returns are better than the cash in the bank account. Then we move up our graph, and we've got property, debt, and then we've got our shares, large capitalization, small, emerging markets. Now, private equity, where it is much more risky, and we would expect a higher return for that, and venture capital. So what is the investment process? This is where you're trying to bring two parties together, those who have the cash and those that need the cash. So the people that can supply funds with those who are demanding funds. They're usually facilitated through banks, so financial institutions. For example, banks, we put our cash that we have spare into the bank, and then they make loans to people who need the cash. It could also be facilitated through a financial market, so the stock exchange. If we have extra cash, we buy shares. The people who need the cash are selling their shares. So there's this exchange happening. Or it could be through intermediaries, stockbrokers or financial planners. They could act as intermediaries for people who need money and those that have it. The main participants in this process, we have government, the different types of government, state, local, federal. We have businesses and individuals. So each of those may act as someone who is supplying funds or as someone who is demanding funds. Usually government and businesses are the ones demanding the funds, and individuals are usually the supplier of funds. We have individual investors. They're managing their personal funds and they're trying to meet their own financial goals. Or we have institutional investors. So they're being paid to manage other people's money. We just talked before about the managed funds. You buy units in the managed funds and they buy the shares and own them, and they are professionals being paid to manage it. Some examples here, all kinds of institutional investors. Don't forget all the superannuation funds. We've got all our superannuation money in with them, and they are investing on our behalf in shares and other assets, and they're managing them for us. So we can see here examples of super funds, Australian Super, Rest, and then we can see banks and other institutional investors. The main financial market we have in Australia, the securities market. So that is the market for the shares, bonds and options. So I've got the stock market, bond market, commodity market and the derivatives market. Now we can describe them as the primary and the secondary market. Now the primary market, that is the market when the shares are being offered for the very first time, the initial public offering or the initial government bond issue. So sometimes you'll see advertising for when shares are being listed for the first time. For example, Coles was separated from Wesfarmers, and they were separated out on their own initial. That would be primary market when they're first available for sale. And then we have the secondary market. That's when they're being traded between investors. So once they've been bought from the company, quite often the company will list their shares, you're buying the shares, the company gets all that money, but after that, all the different people who bought the shares, they can then trade them with each other or with other people, and that's done through the stock exchange. So that's the secondary market.